Welcome to Talk Tickers. We're your shortcut for getting right to the heart of today's earnings calls.
That's right. No waiting through hours of audio. We do the deep dive so you get the critical insights fast.
And today we're digging into the Intel Q1 2025 earnings call. Quite a story emerging there.
Definitely. A bit of a mixed bag, really. They beat expectations in some pretty key areas, but they're also clearly facing some significant headwinds, economic stuff, internal shifts too.
Okay, let's start with the headline numbers then. What did Q1 look like?
So revenue hit $12.7 billion. That was actually the high end of their own guidance.
Oh, interesting. What drove that upside?
It seems like stronger than expected Xeon sales, their server chips. That was the main driver.
And profitability, margins?
Yeah, non-GAAP gross margin came in at 39.2%. That's quite a bit above the 36.2% they guided for.
Wow, okay. Why the jump?
Well, they pointed to really strong demand for Raptor Lake. That's their current high-end consumer CPU, and also better costs on Meteor Lake.
So better margins on key products.
Mm-hmm.
Maybe suggesting they have some pricing power or better cost control than feared.
Could be. It suggests maybe some competitive footing is being regained there, despite the broader economic worries.
Got it. And did all that flow through to the bottom line? Earnings per share.
It did. Non-GAAP EPS landed at $0.13. Remember, they were forecasting basically break even, so that's a significant beat.
Right. So higher revenue, better margins, and you mentioned maybe lower costs too.
Exactly. Lower operating expenses help push that EPS number up. But looking ahead to Q2, the tone shifts a bit. More cautious.
Okay, how cautious? What are they projecting for the second quarter?
Well, the revenue forecast is a wider range now, $11.2 billion to $12.4 billion.
That wider band definitely signals some uncertainty, doesn't it?
Absolutely. It reflects those economic jitters they're seeing. Non-GAAP gross margin for Q2, they expect that to be around 36.5%. So pulling back a bit from Q1.
And the bottom line for Q2?
They're guiding back towards that break-even point for non-GAAP EPS.
Okay. So strong Q1, but a more guarded Q2. Let's maybe peel back the onion a bit. How did the individual business units perform in Q1?
Sure. So Intel products revenue, the core stuff, was $11.8 billion. That's down sequentially, which isn't unusual, but it was still better than they expected internally.
And within that, the PC side, CCG.
Client Computing Group revenue dropped 13% sequentially. Now, that was kind of expected. They sold more units, apparently, but the mix shifted towards lower price stuff. And, well, competition in the PC market is still fierce.
Makes sense. What about DCAI? The data center and AI segment everyone's watching.
Yeah, DCAI revenue was down 5% sequentially, but again, better than they expected.
What drove that beat in data center?
Mostly hyperscaler demand. The big cloud guys, they were buying host CPUs specifically for AI servers and also for storage compute needs.
Okay, and the Foundry business. Intel trying to make chips for others.
Intel Foundry revenue actually grew 8% sequentially to $4.7 billion. That was driven by some customers pulling in orders for Intel 7 wafers, plus more demand for advanced packaging.
Growth is good, but is it profitable yet?
No. Still seeing big operating loss there, $2.3 billion, roughly flat compared to the last quarter. It's mainly due to those really heavy startup costs for getting Intel 18A ready.
Right, that next-gen process tech. What about the all-other bucket? Mobileye, Altara, that kind of thing?
That came in at $943 million, down 15% sequentially, but again, slightly above what they thought. And importantly, that group actually delivered $103 million in operating profit.
So some bright spots outside the core CPU and Foundry struggle. How did the overall cash situation look in Q1?
Well, operating cash flow was $800 million, but gross CapEx, their spending on factories and equipment, was hefty. $6.2 billion.
Oof, that leads to negative free cash flow then.
Yep, adjusted free cash flow was negative $3.7 billion. They did end the quarter with a decent cash pile, though, about $21 billion.
And they got some external cash injections, too, didn't they?
It did. $1.1 billion from the CHUPA's Act grants finally coming through, and another $1.9 billion from closing the sale of their old NAND memory business.
Okay, that covers the financials. The call also seemed to highlight some pretty big strategic shifts under the new CEO, Lipa Tam.
Absolutely. He laid out a strategy really focused on, streamlining things, cutting complexity, doubling down on the core client and server businesses, but also pushing hard on new AI products.
The goal being?
Better products, better execution, basically getting Intel back on track. Part of that involves shaking up the organization, flattening the leadership. Key areas like product, manufacturing, sales, they now report directly to the CEO.
Trying to speed things up, reduce bureaucracy, maybe.
That seems to be the idea, and a huge part of the streamlining is hitting the costs hard.
Right, I saw something about lowering OpEx targets.
Yeah, they brought the 2025 OpEx target down to $17 billion. That was $17.5 billion before, and they're aiming for $16 billion in 2026.
Pretty aggressive. What about capital spending, CapEx?
Also getting trimmed. The 2025 gross CapEx target is now $18 billion, down from $20 billion. They're citing operational efficiencies for that.
But the net CapEx range is still pretty wide, right?
It is. $8 to $11 billion for 2025. That uncertainty is mainly down to the timing and amount of that CHIPS Act funding. It's not fully locked in yet.
They also made waves with a return to office policy.
4 days a week in the office, starting Q3 2025. Management says it's about boosting collaboration, driving innovation. We'll see how that plays out.
And they're still selling off bits and pieces.
Very much so. The big one is selling a majority stake, 51%. In Altara, that's their programmable chip business to Silver Lake Partners.
How much are they getting for that?
Net cash of $4.4 billion. The deal values Altara at nearly $9 billion, which is interesting. Intel keeps 49%. That should close later this year.
Any other divestitures? What about Intel Capital, the venture arm?
They decided not to spin that off completely. Instead, they'll focus on selling off investments from the existing portfolio and just be more selective about making new investments.
So strategically, product-wise, where's the focus now?
It's all about developing best-in-class products, they say. In AI, they're refining their strategy, focusing more on reasoning models, agentic AI, and what they call physical AI. Think of edge computing and inference.
In the manufacturing tech, Intel 18A.
Crucial. It's ramping now. It needs to be ready for the first Panther Lake chip, planned for the end of this year. More Panther Lake stuff coming in early 2026.
But didn't they also mention strong demand for older stuff?
Yes.
Yeah.
Kind of surprising, right? Stronger demand for N1, N2 generation products. They think it's the economy, OEMs being cautious, looking for cheaper options, maybe.
Interesting dynamic. And that older stuff is made on Intel 7, which is still constrained.
Exactly. That high demand for Raptor Lake means Intel 7 capacity is tight and likely to stay that way for a while.
Okay, lastly, the macro picture. Management didn't shy away from that, did they?
No, they were quite open about the uncertainty, pointing to things like trade policy shifts, inflation sticking around, regulatory risks, all potential drags on customer spending and the overall market size.
And tariffs.
They expect tariffs to push up costs, yeah. But they did note their global manufacturing footprint gives them some flexibility, some mitigation there.
Okay, let's zoom out. From an investor standpoint, what are the main takeaways here?
Well, that Q1 beat, especially on gross margin, is potentially a good sign. Maybe cost control is working, maybe they have some pricing power on Xeon and Raptor Lake. But that cautious Q2 guidance is a big reality check. The economic worries are real, tariffs are looming, and the Altara sale definitely shows a strategic focus, trying to simplify and get cash in. The valuation they got looks pretty decent, could be seen as unlocking value.
And the cost cutting, that seems central.
Absolutely. Those big OpEx and CapEx cuts signal a serious push for efficiency. Investors will be watching very closely to see if they can actually deliver on that and boost profitability.
What about the strategy stuff? AI, Foundry?
The AI focus makes sense, trying to catch that wave, but the details are still a bit fuzzy. The edge AI angle seems smart. Foundry, though. That remains a challenge. Still losing money despite revenue growth, and those Intel 7 constraints linger. It's a long road.
And the demand for older chips, what does that tell us?
It's fascinating. It raises questions about, are customers really seeing enough value in the newest tech right now, given the cost? Or are budgets just that tight? It's something to watch.
All right, this is not financial advice. But hearing all that, especially the focus shift, the asset sales, and that weird demand for older tech, does it spark any, let's say, outrageous but plausible trade ideas for you?
Okay, not advice, definitely speculative, but think about this. Intel streamlining, getting cash from Altara, but also seeing strong demand for older nodes. Maybe enterprises are sweating assets longer due to the economy.
Where are you going with this?
So maybe a long position in companies that specialize in secure data destruction and recycling for enterprise storage. If companies delay upgrades, they use older gear longer. When that gear finally does get retired, the need for secure, compliant disposal goes up. It's niche, plays on economic caution and the life cycle of that older, maybe Intel-powered hardware.
A downstream consequence of delayed upgrades.
Yep.
That's thinking outside the box. High risk, you'd say.
Oh, yeah, definitely high risk. Depends entirely on companies actually delaying those upgrades significantly and the compliance needs staying high. But it connects some dots from the call.
Interesting angle. Okay, that wraps up our deep dive into the Intel Q1 2025 earnings call. We've hit the financials, the strategy shifts, the management commentary.
A lot to unpack there. The cost cuts, the Altara sale, the Foundry challenges. That's surprising demand for older tech.
So what stands out most to you listening in? Do you think Intel's cuts are enough to drive real change, or will the macro environment just overwhelm them?
Let us know your thoughts. And hey, any outrageous but plausible trade ideas you're kicking around based on this, we'd love to hear them.
Join us next time on Talk Tickers for another deep dive behind the earnings headlines.